This video is for you if you've ever wanted to learn everything there is to know about investing in index funds in order to achieve financial independence. I want to share with you some information about investing in index funds to achieve financial independence. An index fund is a collection of stocks or bonds that is intended to mirror the performance of a specific index. So let's start by defining what one is. I'll use the S&P 500 index, which is made up of the top 500 American corporations listed on the stock market as an example. When you purchase an S&P 500 index fund, you are investing in the 500 largest U.S. firms because the index invests in all of the 500 companies that make up the S&P 500. Given that index funds are frequently referred to as mutual funds, there is one point we must make clear while characterizing them. Although an index fund is a sort of mutual fund, it is still only one of two types of mutual funds. There will be actively managed mutual funds and index funds, and there is a significant difference between the two in terms of their total composition. Index funds follow an index actively managed funds. An individual who manages an actively managed mutual fund makes decisions about what goes in and out of the fund. We will discuss this very crucial issue in more detail later, but for now, we want to emphasize it. So now that you are aware of what an index fund is, let's discuss the top things you need to know when investing in index funds. First off, investing in index funds is a terrific approach to diversify your portfolio if you just have a small amount of cash to invest. This is because index funds automatically diversify your portfolio for you. If you only have $500 to invest, you might only be able to purchase a few specific stocks. However, if you put that same $500 into an index fund, you can purchase shares of hundreds of different companies. The next thing to remember about index funds is that there are actually hundreds of various index funds that you may invest in. While most people are familiar with common index funds like the entire stock market index fund and the S&P 500 index fund. Therefore, when investing with index funds, you should definitely be aware of your objectives and select the one that best fits them. And this, in my opinion, is a really important aspect, since many people associate index funds with dull, uninteresting investments. You can really invest in index funds that follow highly specialized industries, such as technology or the healthcare industry, that you might find interesting. Therefore, you may invest in an index fund that monitors all medical companies, rather than a specific stock of a medical company. I bring this up because while creating your overall portfolio, there are a lot of options when it comes to investing in index funds. The other one is to not believe the hype surrounding actively managed mutual funds. I say this because when choosing a mutual fund, you may have to choose between an index fund and an actively managed mutual fund. And when you look at an actively managed mutual fund, you will notice a lot of bells and whistles. They will discuss the fund manager and all the resources that make up this actively managed mutual fund to give the impression that because it is active and stocks are traded almost daily within this fund, it is somehow superior to a simple index fund. History has proven that when you simply choose an index fund over an actively managed mutual fund, the index fund performed best. There are many reasons for this, but one of the main ones is that actively managed mutual funds typically do not consistently choose winning investments for their portfolios. The other problem is that actively managed mutual funds have greater fees than index funds, which together with the actively managed mutual funds fund managers' inability to consistently choose winning equities leads to inferior performance than just the index fund. This brings us to our next tip, which is to constantly be aware of and to investigate any fees related to investing in index funds. The expense ratios are the first item you should consider. These costs may differ based on the brokerage firm you use, and I'll show you an illustration. Wells Fargo has an index fund that tracks the S&P 500, and its expense ratio is 0.45%. Now you can visit Vanguard and see an S&P 500 index fund there that invests in the same businesses. The expense ratio is only 0.04%, which is 10 times cheaper than Wells Fargo's expense ratio for the same index fund. Let me know in the comments if you have any other questions about investing. Let's return to the video. The next point is that certain index funds have minimum investment requirements before you can begin investing. The minimum investment requirement can occasionally be a deterrent to just getting started, but once you overcome it, you are free to continue investing any amount of money into that index fund. We just discussed Vanguard since they have some of the higher starting investment requirements for their index funds. But there are other businesses that let you invest with their index funds with no minimum. In fact, Fidelity offers a large number of index funds that allow this. Remember that many brokerage companies have an ETF equivalent to its index funds as well. Since there are many similarities, we won't go into detail regarding how an index fund and ETF differ from one another. You should check to see if there is an exchange-traded fund equivalent if you are interested in a specific index fund but do not have the required minimum investment. And to give you an example, let's go back to Vanguard. If you're looking through their index funds, after you find the one you're interested in, it will show up on the same page as the index fund, which you can click on to find the ETF counterpart. We bring this up because you may always buy the ETF equivalent, which is typically significantly lower. If you are set on investing at a particular brokerage firm, but you cannot afford the minimum investment for their index funds. The next point to keep in mind is that investing in index funds frequently entitles you to dividend payments. Dividends are earnings that a company distributes to its shareholders. So if your index fund invests in dividend-paying firms, you can receive dividends simply by owning that index fund. The dividends from index funds are often paid out on a quarterly basis, which means that if you depend on income from your investments, investing in index funds is an additional opportunity to generate that income. The next consideration is that actively managed mutual funds are less tax efficient than index funds. This is due to the fact that actively managed mutual funds buy and sell a lot. And occasionally, these transactions result in capital gains taxes, which are then passed on to the owner of the actively managed mutual fund. However, since index funds undertake less buying and selling than actively managed mutual funds, your taxes will be significantly lower if you invest in index funds. The last thing we want to mention about index funds is that they are typically capitalization weighted, meaning that even though they invest in many different companies, they don't all invest in the same companies at the same percentage. As a result, you don't get 1% of one thing, 1% of another, and so on. They aren't all equal. Therefore, if the firms they invest in, those that make up a large portion of the stock market, have a higher capitalization or stock market value, they will be owned in a given fund to a greater extent. And this is a crucial point because when you invest in a capitalization-weighted index fund, you are putting more of your money into the larger corporations. Therefore, if you own an index fund that tracks the entire stock market, you will own more technology companies since those firms are the most valued on the stock market. You will also own a lot of Amazon, Apple, and Facebook because these firms are the biggest. If your index fund ever experiences a significant decline, you should look at the larger companies that make up that index fund because it is likely that those large companies also experience a decline in the stock market on that particular day. You will own tiny portions of the smaller companies that make up your index fund. When investing in index funds, you are putting more of your money into the major companies that make up the stock market, which is something you should be aware of because it is all very essential. So there you have it, our position on investing in index funds. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? click on the next videos we have in our channel, showing on the screen right now.